The numbers say the economy should have crashed by now, but it hasn't. And that delay isn't comfort. It's a warning for your job, your savings, and your cost of living. We're surrounded by warnings. Debt is high. Wars are reshaping trade. Institutions are under strain. Headlines talk about the crisis as if it's already here.
The World Economic Forum's Global Risks Report 2026 warns the world is entering an age of competition, with global power rivalries and strategic standoffs now the most severe near-term risk.
And yet the basic signals of collapse aren't showing up. Global GDP is still growing. Markets haven't imploded. Employment hasn't fallen off a cliff. That contradiction is what confuses people. Most of us expect collapse to be obvious and sudden, something you can point to on a chart or feel all at once. History suggests something quieter. Collapse is usually delayed, uneven, and disguised by periods that look stable on the surface. The economy hasn't avoided collapse because it's healthy. It's avoided collapse because stabilizers are still working. Stress is being absorbed, shifted, and postponed, not resolved. In this video, we'll look at what the growth data actually says, where institutional stress is building, how policy is holding things together, and why fragility and collapse are not the same thing. Because collapse is rarely a single event. It's a process. If the global economy were collapsing, the numbers would already show it, but they don't. The world economy is still growing. It's expected to expand by around 2.7% this year, roughly the same pace as 2025, but below the stronger growth of earlier years. That means more goods are being produced and sold than last year, but not by a lot. That headline looks normal until you peel it back. Growth isn't happening evenly. Advanced economies, places like the US, Europe, and Japan, are expanding slowly, often around 1 to 2% or less. Emerging markets, like India and parts of Asia, are growing faster, often above 4%. Put simply, some countries are sprinting while others are hiking up a hill. Now imagine this in everyday terms. If your weekly allowance went up by just a little, you're still getting money, not broke. But if your chores get harder and prices rise faster than your allowance, you're not doing fine. You're just treading water. This is similar to the global economy. It's still moving forward, but the progress is uneven and more fragile than the raw growth number suggests. People often see growth and think everything's fine. But slow, uneven growth is closer to limping than running. And limping tells you there's pressure beneath the surface, even if nothing has snapped yet. And when pressure builds, it doesn't show up everywhere at once. Warnings are louder for a reason. Stress tends to show up in institutions before it shows up in GDP. Take the United Nations, for example. In early 2026, the UN warned that global growth remains fragile, clouded by trade tensions, fiscal strains, and persistent uncertainty. Even as headline growth stays positive, global output is forecast to slow to about 2.7% in 2026, below the pre-pandemic average. That's above zero, but weaker than what sustained long-term progress normally looks like. At the same time, parts of the UN system itself are under clear strain. Funding gaps and unpaid member contributions have created a situation its leadership described as a risk of imminent financial collapse, unless commitments are met or financial rules are changed. This isn't unique to one organization. Governments in multiple regions are facing shrinking fiscal space, meaning less budget room to respond to shocks, even as debt levels remain elevated and social spending needs rise. Policy coordination has become harder, not easier. One useful way to picture this is a building that still stands. The walls look intact, but what if the plumbing is leaking? The wiring is frayed, and the support beams are weakening. You don't see a collapse yet, but the internal systems are under strain. The same dynamic applies here. Public institutions are showing stress long before the aggregate numbers do. That helps explain why warnings are rising, even though headline growth hasn't turned negative. It's not that the system is collapsing. It's that the structures meant to sustain it are working harder and losing margin. There's a reason the global economy hasn't fallen apart yet. One of the main reasons the global economy hasn't collapsed is the presence of policy buffers, mechanisms designed to absorb stress and slow downturns. Central banks are a major part of this. Even as growth slows, many have kept liquidity available and adjusted interest rates to support credit flows. For example, the US Federal Reserve, the ECB, and others have signaled more cautious rate paths in response to weakening momentum, aiming to avoid sharp contractions in demand. Governments also play a role through fiscal policy. When growth slows, spending on social support and public works tends to rise, cushioning households and preventing abrupt drops in consumption. There are emergency backstops too. During past downturns, swap lines between central banks, targeted lending facilities, and crisis lending from institutions like the IMF have provided liquidity and confidence. In addition, automatic stabilizers, unemployment insurance, progressive taxation, and social transfers activate without new legislation, smoothing shocks automatically. These tools slow downturns and reduce volatility, but they don't eliminate risk. They redistribute it over time. Think of it like painkillers after an injury. They let you keep moving and functioning even when something is wrong. The pain is reduced, not the damage. In economic terms, policy does the same thing. Rate cuts, liquidity support, and fiscal spending keep activity going and prevent sudden failure. But they don't repair weak balance sheets, fix productivity, or reverse demographic pressure. What they've done is buy time, not resolve the deeper structural pressures that remain. When people think about collapse, they imagine something dramatic, a sudden break. History suggests it usually works the opposite way, slowly, through accumulation. Accumulation is what happens when pressures aren't resolved, only managed. Take demographics. Global population growth has fallen sharply over the last few decades, dropping from around 1.7% in the mid-20th century to well under 1% today. In many major economies, workforces are aging or shrinking. That doesn't cause a crash. It quietly lowers growth potential and raises long-term costs. Then there's geopolitical risk. By 2026, most global risk assessments aren't focused on recessions. They're focused on fragmentation. Trade is less predictable. Supply chains are shorter and more expensive. Investment decisions carry more political risk than they did a decade ago. Each adjustment is manageable. Together, they make the system less efficient. Institutional fatigue adds another layer.
8 years ago, today, the Economic and Social Council met for the first time. Its mandate was ambitious and has only gotten harder to promote shared solutions to the world's most pressing economic, social, and environmental challenges.
Public institutions are being asked to do more with tighter budgets, weaker coordination, and declining trust. Funding gaps, governance strain, and slower decision-making don't stop the economy. They reduce its ability to respond when shocks hit. This is why accumulation is dangerous. Each shock is survivable. Each response uses up capacity. Systems don't fail when pressure appears. They fail when pressure exceeds what's left to absorb it. So the real question isn't, why hasn't it collapsed? It's, how much stress is still being carried forward? A different way to look at this is also reasonable. The last few years did not break the system. Big shocks hit, and the economy adjusted. Companies changed suppliers, supply chains rerouted, and most people kept their jobs. From that point of view, all the warnings can sound exaggerated. If the system keeps absorbing stress, maybe that's exactly what it's supposed to do. And that argument isn't wrong. Economies do adapt. Markets adjust prices. Businesses change behavior. Policymakers respond. Compared to the past, today's system is more flexible and better at avoiding sudden breakdowns. The issue is what that flexibility costs over time.
Just over 1 year ago, under the radical left Democrats, we were a dead country. Now we are the hottest country anywhere in the world. And this is all great news, and it's great for all nations.
Every adjustment adds something. More debt to keep spending going. More policy tools to manage volatility. More rules and workarounds to keep things functioning. These choices help in the short term, but they also make the system more complicated and harder to manage. Over time, that shifts the risk. Instead of preventing problems, the system spends more energy managing them. That doesn't mean collapse is coming. It means the margin for error gets smaller. This isn't doom. It's a way to understand how resilience today can quietly turn into vulnerability tomorrow. So why hasn't the economy collapsed yet? It hasn't collapsed because buffers are still absorbing stress, including monetary policy, fiscal support, institutional capacity, and the system's ability to adapt, even as those buffers gradually thin over time. This is not a prediction about what will happen next. It's a framework for understanding what's happening now. Collapse is rarely about timing or dramatic turning points. It's about capacity, specifically how much strain a system can absorb before its responses become less effective. Focusing only on growth rates misses that distinction, because what matters more is margin, financial, institutional, and political, and how quickly that margin is being used up. That's why the word "yet" matters. It captures the idea that stability is not a permanent condition, but an ongoing process. The goal isn't to guess outcomes or provoke fear. It's to understand how complex systems hold together and what quietly weakens them over time. Stability isn't permanent. It's maintained. And when the buffers thin, things change quickly. If you want to understand how money, risk, and systems actually work before the next adjustment happens, subscribe. We'll keep breaking it down. See you in the next one.